Yes, sir. Can see you just fine.
The eighth wonder of the world, understanding compound interest. We're going to talk about small changes that can make a huge difference. I think most people understand, and most investors understand uh, what compound interest is and what it is. Um, but we're going to take it a step further and talk about the risk that comes with it as well. We cannot have one without the other. We're going to examine risk along with compound interest, and we're going to talk about what risk is. Is it volatility? Volatility is often confused with risk. People use the words interchangeably, and most often they use the word risk, not volatility. So that's where we want to go today. That's what we want to do. Einstein said it. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. We have a passion for creating wealth. What does that really mean? What does that really mean? um, you know, if you invest $500,000 and 10 years later it's 600,000, you've made money, right? Isn't that creating wealth? I go to trade shows and they go up with their trading systems and they show that people are making money doing those trading systems. Yeah. And I'm convinced that most of what they say is really true. People go in, they have 500,000, they're up to 600,000. They made money. But is 10 that going from 500,000 to 600,000 in 10 years? Is that really making money? Is that really a reasonable amount? How do you know? What's a reasonable amount? What should you be making? I think that's the question. It's not, are you making money? It's what kind of return are you getting? What kind of return over a period of time? When you think about it, just a 1% difference, 100,000 invested over 25 years at 5% will go to 338,000. 100,000, that's tripling your money at just 5%. That sounds pretty good. If you just increase that just a little bit, 6%, it grows to 429,000. People look at that and think 5% to 6% is not that much. It's 1%. Is it a really big deal? Think about what that is over 25 years. And that's a $90,000 difference. 1% over 25 years, just one small percent, means at the end of the time, a 21% increase in the final value. If you're an investor and you have funds to invest, and someone tells you they can get 6% instead of 5%, that means you make 21% more. It also goes if somebody is charging more. The average financial advisor gets around 5%. They charge 1%, which means they're really making 6% gross. That means they're collecting 90,000 in commissions and fees. That's why expense ratios and fees matter so much when you're talking about a 5 or 6% difference. We do charge 2% at Adams Financial Concepts. Is it worth it? We think so. We think it's really worth it. When you look at the difference between 5 and 6%, 21%. But think about the difference between 500,000 growing at 5% grows to 1.6 million. 1.6 million seems very, very nice. 500,000 at 15% for 25 years is 16 million, 10-fold difference. Sure, 10% doesn't sound like a lot of difference, but think of that, what that really is. 10-fold. Now, let me stop a minute and ask if anybody has any questions. Chris, if you're there, is anybody putting any questions into the chat? Does that make sense?
Mike, I'm here and let's just give people just a quick moment. If anybody has any questions, we want to make sure that this makes complete sense to you. It's one of the rare times, Mike, that we break midstream to make sure because everything you do from here builds upon this. So if you have a question, you can either toss your hand up so that I see it or pop it in the chat or the Q&A. But Mike, looks like we're good. I'll jump back in if anybody does.
So small differences make big differences in the end. We're talking about money growing at a compound type of interest. So if we look at it, it is significant. Every percentage point matters. The difference between average and excellent returns over decades isn't just noticeable. It's truly life-changing. It's why performance makes such a difference. I've talked in the past about the average financial advisor getting 5%, 5.2%, 5.3%. We're doing a lot better than that. And you as investors should be looking at your portfolios, how they're performing over a period of time. It makes a very significant difference. And that doesn't mean that the portfolio return won't go up and down over a period of time. It does. But small differences can make a huge impact. When I first started out in this business back in the mid 1980s, I opened an account for a postman. He was retiring. He was 65 years old. He had 216,000 of pension money to invest, and he gave 108,000 to a Merrill Lynch broker. He gave 108,000 to me. At that time, I was a stockbroker, as we didn't. Financial advisors didn't come into the literature until after '87, but until actually close to the 2000s. But 108,000 to Merrill Lynch, 108,000 to me. And by the mid 90s, the portfolio had grown. He gave me a call one day and said, I want to buy you lunch. He lived in Tacoma, said that he wanted to drive to Seattle and buy me lunch. And by now, he's in his mid 70s. I can remember him driving up the freeway and saying, these drivers drive so fast. He drove about 45 miles an hour on I-5. Cars passing him all the time. So we sat down to lunch. And as we sat down to lunch and talked some, during the period of time, up to that time, I talked to him in the early days about moving the Merrill Lynch account to me. And I'm sure that the Merrill broker talked to him about moving the account he had with me to Merrill. But as we sat down to lunch, he said, my account is now $1 million. It's grown from 108,000 to over $1 million. He says, I really appreciate that. I said, Frank, how is the Merrill Lynch account doing? And he said, it's 140,000. I probably should move it to you. I said to Frank, he's doing okay. He's doing what the average advisor is doing, the average stockbroker is doing. I said, you probably should keep your account at his place, just so you know the difference. Generally, there's a difference. If you're not measuring the interest, the compounded rate of growth, you're missing out. And the fact is, as you increase the rate of return, one thing that happens is volatility picks up. Understanding compound growth comes because there's a form of risk. What people talk to and understand is risk. What's talked about is risk. Because stocks go up and down, the market goes up and down. I have always said that I can predict the weather. I can tell you that it's going to snow in Seattle. I can't tell you the day it's going to snow. I can't tell you when it's going to snow, but it's going to snow. I can tell you as the rain pours down in Seattle, and right now it's kind of cleared up, but I can tell you the sun's going to come out. Can't tell you when, but I'm pretty confident that that's going to happen. The same same thing is true of the stock market. I can tell you, I can predict the stock market, how it's going to perform every day. It's going to open, it's going to go up, it's going to go down during the day, and it's going to close at the end of the day. That volatility is what most people consider risk.
Mike, could I just jump in really quick? And
Sure.
a question has come in saying, so buying stocks every month with a certain amount of consistency through up and down markets stimulates compounding growth or simulates compounding growth.
No,
I
buying
think that I think
dollar
that's a conversation of dollar cost averaging.
dollar cost averaging does not do anything for compounding growth. Dollar cost averaging means you add a little bit, and it's the question of what grows every month, how much it grows. Adding more money doesn't increase the growth. Picking the right stocks increases the growth. Yeah, that's the key as to what you invest in. That's the key. Hopefully that answers the question. So what most people think about let me shift back into this. What people most think about risk is volatility. And if you look at what happens, the market is down about 10% every other year. You see, you get what's conventionally known as a correction. Does it mean the economy is going down? Does it mean the stocks are more risky? No. It's simply that people buy and sell and they move in and out. Does that mean every other year when it's down, we should worry about our money? No. It's just a fact that goes along with life. It's just like I talked about, it poured down rain in Seattle. That happens. We get rain. A few years we get snow. And a few years we get freezing. A few years we get 100-degree weather. That doesn't mean that things are changing. That doesn't mean that it's anyway. The market going up and down doesn't mean that there's a huge risk. If you go back and think about the really tough times, the Great Recessions and the Great Depressions, you know how often they happen? 1819, 1825, 1837, 1847, 1857, 1866, 1873, 1884, 1890, 1893, 1896, 1907, 1926, 1929, sorry, 1933, 1938, 1973, 1987, 1998, 2000, 2007, 8, and 9, 2000. All of those times we went through a Great Recession or a depression. All of those times. Economic panics, what we call systemic risk, systemic events. And you know what? We survived each and every one of those times. Every one. If you draw a graph of the stock market, it starts in the lower left-hand corner and goes to the upper right-hand corner. The trend line is up. It doesn't mean that goes down. Volatility, we call it risk, but the reality is it's volatility. It means the stock market goes up and the stock market goes down. It doesn't mean the economy is cratering. It doesn't mean things are going to zero. The reality is if all the stocks go to zero, we have bigger problems than the stock market. Volatility is volatility. We call it risk, but is it really risk? There are types of risk. Risk, permanent loss. If a stock goes to zero, that's a permanent loss. You buy it at 10 or 20 or 40, and it goes to zero and goes bankrupt. That happens. That does happen. In the time I've been in this business, 40 years, I've actually experienced it twice. Once in the early 1980s and once a few years ago, where a stock goes to zero. Actually, I sold the stock before it got to zero. But stocks do go through periods of time when people cook the books. Don't have to go back very far and think during the dot-com times of Charter Communications. It was considered one of the best stocks of the dot-coms. In 2000, it was an A plus rated by First Union Bank, and their analyst, A plus stock. At the beginning of 2000, by the end of 2000, it was bankrupt. Enron, WorldCom, you can go down a list. Those are permanent losses. Those are real risk. That's what you want to avoid if you possibly can. But it's going to happen. Nobody can tell. When companies cook the books, the stocks go to zero. But there's also another one that most people don't think about, and that's time risk. Real time risk. You know, um, if you think about the difference between treasury bills and stocks, and ask somebody what's riskier, treasury bills guaranteed by the full faith and credit of the US government, or stocks, what do you think? What do you think is the real risk? What's riskier? Think about which is riskier, treasury bills or stocks? Let me give you an example. If you buy a treasury bill that's paying 3 or 4% now, and you hold that treasury bill and roll it over every 3 months when it comes due, at the end of 20 years, you'll have just under $200,000 if you invest $100,000. $200,000. If you invest in the stock market, you'll have $1.5 million on the average over 25 years. What's riskier? What ends up with more risk? The treasury bills or stocks? Over the long period of time, you have to know that the treasury bills are not going to give you the yield that stocks are going to give you. On a short-term basis, if you need the money in 3 months or 6 months or a year, much better to put it into treasury bills than into stocks, because stocks are volatile and they can go down. Treasury bills, 3-month treasury bills are not going to fluctuate very much. So that's a risk of time. In order to understand real risk, you have to think about time. You know, that's the types of risk. Volatility is the price you pay for higher returns. The real risk is not giving your money enough time to compound. No, that's where it is. Treasury bills versus stocks. If you look at it for a very short period of time, treasury bills are much safer. You're going to get your money back out for a short period of time. Stocks over a long period of time are going to be less risky than the treasury bills, because those treasury bills are being eaten up. The returns are being eaten up by inflation, even a very small amount of inflation, 2%. If you're getting 3 or 4% for a treasury bill, that means you're giving up half the return to inflation. But there is another aspect to think about as well. And that's diversification. Does that make sense? Are there questions about that?
Like we've had a couple of comments come in, just with some venturing some ideas on the questions that you asked. But some of the things you're saying, somebody said, I've never thought of it like that. And JJ contributes by saying drawdown in total returns from 1928 to 2025, and he's provided us with some graphs and charts that we could explore. Somebody says at a certain age, over long periods of time is why I don't buy green bananas. Mike, that sounds very familiar, doesn't it?
I've used that phrase before,
Yeah, yeah. So
actually.
no other questions, but I just wanted to share the comments that had come in.
And that's a good point. Uh, I first heard that phrase from a client who was in her 90s or 80s. Must have been, no, she was in 1999, she turned 99. She was born in 2000, born in 1900. Her birthday was the same birthday as mine. When the market crashed in 87, I had been talking to her about municipal bonds. She'd been buying municipal bonds. She was one of the wealthiest women or wealthiest people in the state of Washington. I've been selling or talking to her and selling her municipal bonds. When the market crashed in 87, she said, should we be buying stocks? I said, it depends on your age. She says, you know, she was in her 80s, late 80s by that time. She said, you know, it's about a matter of time. She says, I don't even buy green bananas, but I want to do stocks. And she did stocks. So anyway, that was a diversion. Um, there's a reason why you do some diversification. Owning one stock or owning two stocks is considerably risky because a stock can go to zero, no matter how good it is. Boeing, huge company, but on the day somebody invents one of those transporter machines like they had in Star Trek that can transport you without a vehicle, that's the day in which Boeing goes to zero. So, and that's probably a way out there example. But things happen, technology changes. There's half the companies, according to research, are at risk of dying. Half the companies, maybe even more, being replaced by better technology. As we talk about AI, as we talk about synthetic biology type things, a lot of companies are at risk of going to zero. Owning one or two companies doesn't make a difference. But studies have shown that owning 50 stocks doesn't really reduce the risk meaningfully. You dilute your best ideas, and it's impossible to track everything. We do our own research. We spend a lot of time doing our research. Trying to do the research on 50 stocks or 100 stocks or 300 stocks means that you're so diluted, you miss a lot of things that are going on. Increase the cost, it increases the complexity. You end up with getting worse returns with that many stocks than you do with a few stocks. There's studies that have been shown, pardon me, studies have shown there's no statistical difference in owning 8 or 9 stocks and owning 300 stocks. That's why we build our portfolios with 8 to 12 stocks. There's no real difference in the statistical risk. More volatility, for sure, but statistical risk, real risk, none greater. There's very few large investors that have done really well. If you look at Templeton and Price, Buffett, the only one that really had a lot of stocks was Peter Lynch. He managed the Magellan Fund for 17 years and got so burned out because he was spending so much time doing so much research into the stocks that after 17 years, he said, I've had it. I'm not going to do this anymore. And he bailed. He had outstanding returns, but he bailed. There's only 1% to 3% of professional money managers that are actually beating the S&P 500 over the 10-year time period. We've been doing it for 20 years. So there's two aspects to that. One, a phrase coined by Peter Lynch, diversification is too much of a good thing. It's diversify, diversify, diversify. And having too many stocks is actually diversification. It is something that people do. And the less research people do, if you're managing your own portfolio, if you've got somebody managing, the less well-known, the less research they do, the less they know about the individual stocks, the less they know, the more you should diversify and give up on the idea of, of doing well. Reduce the compounding, reduce the risk, because you want to be sure that the stocks move well. The less you do in terms of research and knowing the stocks, the more diversified you should be. Um, we know our companies in detail. I want to move as as individual retail investors. You know something? Institutional investors love you. Institutional investors, whether you're a physician, whether you're a business person, whether you're retired, whether you're an executive at a firm, whether you own your own business, whatever you are, if you're a retail investor, institutional investors love you. So do algorithms. They love you. They really are happy that you're in the market, because for every happy buyer, there's a happy seller. For every happy seller, there's a happy buyer. Institutional managers, professional money managers, need retail investors. They need the retail investors so that when they give up on a stock, when they're out of the stock, they need the retail investors to invest. You read the stories. If you listen to the stories, if you read the stories, you see things like, what's the smart money doing? What are the gorillas doing? What are the gurus doing? What's smart money doing? Look at it. Think about it. Time and again, you see people talking about and articles about smart money. They're talking about institutional investors. They're talking about the algorithms, all of those. And think about it. Only 1% to 3% of those institutional investors, that smart money, and even the algorithms do not beat the Standard & Poor's over the 500. Standard & Poor's 500 total return. That's just a fact of life. You know what? They call you the dumb money, because when they want to sell, they need you to buy. When they want to buy, they need you to sell. You know what? Our clients are actually beating the Standard & Poor's 500 over the long term. Looking back at where we are, we're beating a lot of institutional investors. If you look at how we've done, and now I'm patting myself on the back, of course. If you look at where we've done, if you look at the Standard & Poor's 500 over a period of time, we're actually doing better than the Standard & Poor's over the long period of time. We're doing as well as the Standard & Poor's. We're actually, over this period of time, we're doing 15.96%. The Standard & Poor's is doing 15.94%. But we took a big gap down, talked about volatility earlier in the program. We took a gap down. This is a 15.9%, 6% return. For somebody that started with us in 2009, they would be up here. 500, if they started with 500,000, they'd have 5.4 million. 15.96% return. 5% return for financial advisors, 500,000 would have turned to 1.2. Still nice a return, still nice, 1.2. That's dumb money. I think I have to be calling my clients from now on the brilliant investors, the brilliant money. They are actually beating 97%. of algorithms and institutional investors. That's where we are. That's what we're doing. And of course, I always have to put up the fact that past performance is no guarantee of future returns. We use the Standard & Poor's 500 dividends reinvested because it's the toughest index to beat, general index to beat. And there are now over 3 million different indices. We do it. And what we have in that, we have all of our active accounts, every one of our growth accounts. It includes people who have as little as 1 quarter with us, 1 full quarter. It includes people that have left. Either they've moved their account away, and we do have people that move the account. We did have people who, at this period of time, did move their account. Think of what they missed out on. We have people that have passed away. All those accounts during the time that they were active are included. And all those accounts are net of all fees and expenses, all cost. They're net. They don't include the incentive profit sharing accounts. And that's actual, all equity growth accounts with 1 quarter. Concentrated in as few as 8 equities, William Sharpe received the Nobel Prize, showing there's no significant difference in volatility risk for 8 or 9 stocks as compared to 300. I mentioned that before. Anyway, the accounts include capital gains and losses, and there have been losses. Stocks that have lost money, the gains have outperformed those. I like what Peter Lynch said as part of our disclaimers. I'm always fully invested. It's a great feeling to be caught with your pants up. And yes, that may change if we go into a very large period of stagflation. But there's going to be times of periodic losses, setbacks, unexpected occurrences. Those drops don't really bother us. Yeah, it was a big drop, but look at the total curve. Look at where people are. People who started at this point are now here. People who started here have not seen as big an increase. People who started in this period of time haven't seen a big increase. We think this curve could continue to grow. So anyway, patting myself on the back. That's where we are. So with that, I want to say compounded interest. Albert Einstein said it's the 8th wonder of the world. He who uses it benefits, who doesn't pays the price. It is an incredible thing when you get compounded interest, and small differences make huge difference in the long term over time. So that's where we are. And going with compound interest is increased volatility. And with that, let me ask if there's more questions and discussion.
Hey, everybody, it's Chris Browning. I am back to handle your questions. So if you do have a question, we've got a couple queued up, Mike. If you have a question, pop them into either the webinar chat. Keep in mind that if you pop it in the chat and you send it to everyone who is here today will be able to see your question. So if you only want me to see it, you have 2 options. First, you can send it to hosts and panelists, and then I'll see it. Or you could put it in the Q&A section. So, Mike, the first question is, the market has been in such a bull market for a very long time. Will buying now be a good time?
Whether it's a bull market or a bear market, there are always companies that do well. There were companies that did well during 2008. There were companies that did well in the dot-com time. It's finding the right companies. It's also realizing that during tough times, the price earnings ratios shrink. It's not that the companies don't do well. It's a time in which things go well. If you look at a bull market, we have been in a bull market since 2009, and we're probably going to continue in some semblance of a bull market for the next year, maybe 2. It's planning on where we're going and being in the right place at the right time. And yes, I do very few trades, but if we come into a period of time where stagflation, and stagflation is one of those things that grows slowly, you get the frog in the water example. There are things to buy.
Mm. Thanks, Mike. For those of you who are here and curious about speaking with Mike, I have entered his email address into the webinar chat. You can email him directly. He checks and responds to every single email that he gets. So if you want to consult with him offline, his email address is the great way to do so. Mike, next question that's come in. I'm 52 years old. Am I late to start investing meaningfully?
No, the best time to have started was yesterday. The next best time is today. 52 years old. I'm 82 years old. So if you live to be my age, that's 30 years.
Mm.
Think about the example that I gave of 25 years of investing. Well, 500,000 grows to 16 million over 25 years at 15%. Will we see some slowdown? Maybe. Will we see some speed up? Maybe. But now is the time to really start investing. And a lot of people have had a lot of family things, education, building up income. So you're not alone when you're 52 years old to start investing. Would have been better 30 years ago, but now is the time to really begin.
So, Mike, somebody says the growth and profits are on paper. When do you actually realize the profits?
When you need those. I gave the example of Frank Klarich. Frank Klarich, the postman. So Frank had never married, had no children. His portfolio was built up to past the $1 million mark to almost 2 million. And he lived in Tacoma. He had a small home in Tacoma, very close to downtown. He was there one day. A homeless kid came up and said, "I'll cut your lawn for 20 bucks." And Frank said to him, you were here before. You said you'd cut my lawn for $20. I give you a $20 bill and you took off. You never cut my lawn. He said, "I'm not going to give you $20 because you should cut my lawn now because I already gave you 20 bucks." The kid knocked him down. Kid started kicking him, kicked him in the head
Mm.
again and again and again. Caused brain damage. Caused so much brain damage that Frank needed, at best, to be put in special care, special brain area. And I don't know what you call him, but I visited him a few times in care in these facilities. The kid only got 3 years of prison for what he did. Frank ended up the rest of his life, and he lived another 17 or 18 years in a facility like that. Had he had only 140 or 150 or 160,000 as the Merrill broker given, he would have gone into a family home or into a nursing home, would have been dependent on the state. As it was, the funds that he had were enough to see that he got that special treatment for the remainder of his life. And I hope
Mm.
nobody that's listening to this ever experiences that. But right now, as we get older and older, the probability of experiencing something really, really disastrous increases all the time. Having enough money to be treated in the correct facility and specialized nursing facilities, specialized facilities is truly, truly important. I was able to give that to Frank. One of the things which I'm very happy. I guess I'm 82 years old, and I like to know that I can make a difference like that in people's lives.
Hmm.
Anyway,
Mike, thank you. That was a very thoughtful answer. Next question that's going to come in. My wife and I have a pretty dark view on the state of the world and the potential impact on our nest egg. With all that's going on, we believe that the economic macro volatility that exists and will continue is unlike anything we've seen before. And we're concerned that economists and financial analysts may not be able to deal with and will likely lead to big impacts on GDP growth, inflation, interest rates, employment, corporate earnings in many sectors, and more. How are you preparing for this brave new world? What a great question, Mike.
It is. And the outlook is not that different from mine. I I do agree. I think we're coming to a time that's going to be very, very difficult. But then I think about this. So, do you think the dentist is going to quit doing teeth? Do you think the doctors are going to quit treating you? Do you think the restaurants in total are going to close down? There's going to be some that go out of business. There are always some that go out of business. Do you think people are going to quit making clothes? Do you think the car manufacturers are going to stop making cars? Do you think that everything's going to go to zero? If everything goes to zero, we have greater problems. And it doesn't matter whether you're invested in stocks or not invested in stocks. Um, I'm preparing, looking at those type of companies which will do well during that period of time. Very, very conscious. I lived through stagflation. I remember times, and I was in business during that period of time. I can remember talking to other business owners. I can remember talking to one. I can remember talking to a couple. One, how's business? He said, unbelievable, unbelievable. So what does that mean? He says, it's so bad that even people who don't pay their bills aren't buying. Um, I mean, things went through that period of time, really, really difficult times. But there are companies during that period of time that did really, really well. So there will be companies that do really well. Dentists won't stop doing teeth. Doctors will not stop taking patients. Clothing companies will not quit making clothes. Car companies will not quit making cars. They may cut back and probably will cut back, very significantly cut back. But it's not going to be the end. It's not going to be the car companies of Cuba. Um,
Mm.
we're going to see some things continue to go forward. And no, I would not be invested in car companies, and no, I won't be invested in clothing companies. And no, I'm not investing in restaurants either. But there are going to be companies that succeed. And so that's where I want to be. And I know that half of the picks that I make will probably be wrong. So the other half have to make up for the ones that are wrong. So, yes, I have a very dark opinion as well. I want to take advantage of the good times where they're good times, but I also want to be in those companies which during dark times that could be coming, and I say could, it's not certain, no one has a crystal ball, but if there are very dark times coming, I want to be invested in those few companies that are going to do or have a high probability of being very successful during that period of time.
Mm-hmm.
It is going to be a dark time. I keep talking about it. Keep saying to people, now is the time to prepare. Now is truly the time to prepare.
Mike, I'll zoom in on a comment in that question, and I know you'll have a response to this. And he says, it's unlike anything we've seen before. And you often say,
It is. History does not repeat, but it rhymes. Yes, it is something we've never seen before. I mean, up until this administration, the United States was the world leader. Everybody looked to the United States, whether it was the CDC, whether it was the financial markets, whether it was military defense, people looked to the United States. The world order is changing and has changed. Some is positive. I believe it's positive for our European allies or our European counterparts to realize they can't depend 100% on the United States to back them up. I think it'll be positive. I think there's negatives as well. I think it was expressed by my granddaughter, who's just 21 years old, who says, as a scientist, she does not see her future in the United States. So there are dark times coming. Yes,
Yeah.
but be prepared.
And Mike, of interest, just a couple of weeks ago, you did a talk about how you have been through just about anything that somebody could go through when it comes to investing, because you've been doing it for more than 4 decades. And so I would invite people here, if you want to catch that episode, I'm putting a link in the chat to the YouTube channel. It's called About Money Radio. You can go there, and that is where replays from all of these broadcasts go, and you'll hear Mike's insight on what he's learned in 40 plus years of investing. Mike, one more question. Oh, go ahead.
I had one more comment.
Yeah,
Things that have never happened before happen all the time.
that's what I was waiting for.
You know, pandemics happen. Anyway,
That's the one. That's the one I was waiting for. Things that have never happened happen all the time. Never happened before. Mike, somebody says, is it better to invest in one lump sum amount or better for monthly additions to the investments?
in the long term, it doesn't make a bit of difference.
Yep.
I mean, I can go back. The stock that was in my portfolio the longest was $10 to $12 and 93, 94. It split 2 for 1, 3 for 1, 2 for 1. And today the cost basis on that stock for people that owned it in 93, 94 was 87 cents to $1.02. The stock is at 80. I started cutting it back in 2018 when it was over 100. So whether people bought a little now over a period of time or whether they bought it all in a lump sum, whether you bought it at 87 cents or $1.02, when it's $87 or 110, which it got up to, it doesn't make a lot of difference.
Mm-hmm.
If you're looking for it over the 20-year time period, it doesn't make a difference. If you're trying to beat the market, like a lot of traders are doing, over day trading or monthly trading or even yearly trading, then it makes a difference. We're focused on the 5 to 10-year time period. That wipes out a lot of that difference.
And so one more question that's come in, Mike, and while I will say, while we are here every week to educate, that is our primary directive. Somebody asks if you're sharing any offer today. So Mike, I'll let you handle that one.
An offer?
An offer. What would you like to offer these people, Mike?
I'm giving you all my knowledge on this program. You're getting that for free. So yeah.
How about email Mike and hop on his calendar for a chat so that he can look at your unique situation and talk about the unique moves that you should be making. Mike,
Yes.
somebody says, what would be your outlook for the upcoming dark period? The potential, I will say, the potential dark period. What's the expected time frame?
16 to 30 years.
Hmm.
Actually, I'm not, if you look at bull markets and bear markets, secular bull and secular bear, 1966, the stock market entered a secular bear market, lasted 16 years to 1982. from 1982 to 2000 was 18 years. That 18 years was followed by 9 years of a bear market. So maybe bear markets last half as long as bull markets. We've been in this bull market uh, for 16 years. Maybe it will be as short as 8 years. Maybe it will be 16 years. It's not going to be 3 months. I don't, and
Mhm.
again, no one has a crystal ball to know for sure.
Yep. Mike, I have a question, and that question is, what's coming up next week?
Next week. Next week is show me the proof.
Hmm.
So it's it talks about people read books, people read articles, people talk about making money. I want to see proof. I want to see proof. I don't want to be conned or scammed. I don't want to be taken in by a Victor Lustig. So that's next week.
That sounds great, Mike. Mike, another
And let
question's come
me
in. Oh,
go
go ahead,
ahead
Mike. No.
if there's
Uh,
a question.
This is here, Mike. Here's what I love about this one. They're referencing something we talked about last week. So, Mike, last week you spoke about your strategy to build up as much wealth as possible to weather the storm. It sounds like you're still planning to stay invested, even if we have a 16-year bear market.
So if you look at the studies, it shows, and the first studies were done by Peter Lynch, showing that if you miss the best 10 trading days out of 10 years, your return went from $14% in the Standard and Poor's 500 to 4%. If you miss just 10 days, that's an average of 1 day per year. There've been a lot of studies that have been done since then that show that being fully invested is the right strategy. Yes, if you miss the worst days, you get a much better return, but then you have to guess which they are. The reality is, in my opinion, all those studies have been done during secular bull markets or included a secular bull market. I've been invested, fully invested for clients for 35 years,
Mhm.
thereabouts. It took me a few years to get into this. Since 1990, December 31st of 1990 was the first one. So that's 35 years, 30, coming up on 36 years. Um, I will not be fully invested, I don't think, if we really hit the dark times. That's why I say it's important now to build up. Uh, that's that's where we are. That's what I want to do.
Mhm.
So I won't be fully invested as the times get darker and darker.
Thanks for that answer, Mike. Uh, so once again, I'll remind everyone here, a couple of links in the webinar chat for you. One is Mike's email address. I know, Mike, you love to get emails from people that are here, so feel free to send him an email and he'll respond to that email. And then I also above included the link to the YouTube channel where generally we have the replay up by Monday of the coming week. And you'll be able to check that there. But in the meantime, you can look at past episodes, and there are dozens of them. So there's a lot to learn, and that's a great resource for you. I would ask that if you go over and you find value in the channel, please subscribe so that you get alerts whenever we post new content, and you get that content before anyone else. What more could you ask for? And I will ask if there are any last questions as we wrap it up for today. I'm just watching the chat and the Q&A, Mike. I haven't seen anything come in, but why don't we give them 30 seconds for that? And maybe if you are typing a question, you could just like do a little hand raise for me so that I'm watching for it. All right, I don't see any hand raises. Oh, there we go. We do have somebody typing in a question. I saw the hand raise come in. So, Mike, we can just pause for a second and wait for that question to come in. Here we go. Let's see. Somebody's asking about the missing the best 10 days. And they're wondering they're questioning the timing. If you miss the 10 best days, uh, without also missing most, if not all, of the 10 worst days. In that circumstance, your results improve. I'm curious as to your thoughts on that.
Oh, if you miss the worst days, you have a much better return. All you got to do is figure out what are going to be the worst days.
Yeah.
By being fully invested, you get the worst days, you get the best days.
Yeah.
So let me, we're coming to the end of the hour. Let me leave you with a parting thought. I like this. When you think about the volatility, think about this, the 20th century. We went through a great recession, depression. We went through numerous recessions, the 60s, 80s, 1900s, and in between. We went through two world wars. We went through the Vietnam, Korea, worldwide multiple conflicts. We went through communism and the Cold War. We saw two presidential assassinations. We saw Chernobyl and nuclear meltdown. With all those problems and issues and unpredictable things happening, with all those negatives, the Dow Jones started at 66 on January 1st, 1900, and ended at 11,467. It started in the lower left-hand corner and ended in the upper right-hand corner. So that's the parting thought. Have a very good week, and I hope to see you all next week when we talk about show me the proof.
Mike, you're getting applause. You're getting applause emojis. I don't want to take the last word, but you're getting people sending applause emojis into the webinar. So, uh, congratulations on that, Mike. Mike, bring us home.
Thanks much. Have a wonderful day and a wonderful, wonderful time. Uh, anyway, I want to bounce out of this and stop the sharing.
And Mike, JJ has asked us to remind him what next week's topic is before you go.
Anyway, take care.
Oh.
Have a wonderful, wonderful weekend and a wonderful week. Keep making money.